Thanks for joining, everyone. Erik, thanks for joining us today. We've got Erik from ES Invest, someone who actually knows something about the options market. There's something going on in the options market. I thought people were interested. I'm seeing a lot of questions all over social media about what's going on. We've seen some really crazy stuff from Roaring Kitty and a massive options position. We've seen some wild options market activity to close the day today, June 12th. And so we thought we'd come together and start with looking at what the most recent position analysis can tell us about what Roaring Kitty's position is, what his P&L is as of today, if all holds the same, and what we think his strategy might be here. We're going to get to your questions. We've got a lot of questions online about all sorts of stuff with the position, with the options market, and all sorts of fun speculation, of course. And then to finish it up, we're going to go through all of this crazy options trading activity that we saw to end the day today, and give you, some pretty, on the spot analysis. And that's why I have asked Erik to join us here, who's an advisor to Irvin, a friend of the program. He's on our Let's Talk Markets podcast regularly. And he runs an amazing channel on YouTube called ES Invest, where he teaches retail investors about the options market. So Erik, thanks for joining.
Yeah, absolutely. This whole thing has been an absolute blast to watch unfold. I couldn't be happier ever since I saw options even loosely integrated into this. It's like seeing your two favorite superheroes come together and just see what happens. And what you flagged at the beginning of the video, which I'm really excited to get into towards the end of the video, is looking at what happened today, because things started moving a bit. And I think it'll be really, really fascinating to dive through what we think is going on there, because there's a bit you can infer from options markets. But before we get into that, I think exactly as you said, it would be great maybe to do a quick update on his position, which was last updated on 10 June. We haven't seen anything for 2 days, but that's the cool thing about markets, right? Is I can see what spot price is, I can see what his average prices are, and we can then infer what the position looks like, because a big part of the way that this thing unfolds depends on the P&L of these trades pretty massively. So if you want to start there, we can pull up the screen and then, we'll start running through some of these.
Okay.
Perfect.
Here we go.
So as we know, obviously, meme lord Roaring Kitty has some fantastic recent memes that he shared with us. This one is hilarious. Yeah, with this one, obviously we have GameStop, and then we have the kitty in the pocket, which I think you can kind of infer what this one means for us. And for those that haven't seen this video, which is on his channel, or I guess on his profile, you absolutely should check it out, because it's hilarious. It starts with the Inglorious Bastards intro. This might be my masterpiece. And the fact that he had a news agency with the term breaking news with him underneath the perfect.
It's a brave new world, man. Everything has changed. It's really incredible.
It's literally perfect. So let's take a quick look at his position. So again, this is from his post on the 10th of June. And you can see what his prices are for these positions. So we can see that he has 5 million shares, and he paid on average 21,274. The reason why this matters to say on average is because when we're transacting in these sizes, you don't just get to enter that all at once. He would have gotten multiple fills that eventually aggregate into the position that he has. And it's the same thing for the options side of the equation here. The last we saw, he was holding 120,000 of the June 21, I guess I should say 21 June to be clear, the 21 June 24, 20 calls. So he still has a pretty sizable position in here. As we saw, the outlay for this is like 68 million bucks. So he was up a few hundred million, down a few hundred million. We're just watching the roller coaster unfold. But here's essentially
a couple hundred million between friends, right? Oh my gosh.
Who really cares? I think that actually really is what makes this such a interesting thing to follow along, is because I'm curious your perspective, but from what I'm seeing, we're watching somebody who clearly is not centered on the financial outcome of the position. Obviously, he's trying to make money. That's very clear. But he had a position that was up $200+ million. And most of us would probably grab that in a heartbeat. That's life-changing, literally generational changing money. And he's still going further. So what do you make of that move?
I honestly, I mean, but I don't mean to be crude, but balls of steel, man. Just balls of steel. I don't know how else to put it. When you look at, he's on the live stream, he's lost, a couple $100 million, and he's just laughing and drinking a beer. It's otherworldly. Like I've been trading for a long time. When I was in HFT, like our models were swinging pretty large numbers, and a bad day was orders of magnitude under that, and just just insanely awful. And here this guy is just like joking around and memeing and laughing and looking at I don't even know, like I have no words for that. It blows my mind, completely blows my mind.
It's one of the reasons why I've become so infatuated with this whole thing, is because it's just, you have all the elements of a fantastic story. Yeah. Because, Roaring Kitty at the center of it, I would actually consider it not a fully rational actor. Because again, like most of the time when your position's up massive, you try to take profits at some point.
Super Stonk is going to really like that characterization.
Yeah. And I think it's because at this point, when most people interact with markets, you think that they're out there trying to make as much money as possible, but you're dealing with somebody who's almost transcended that. And it really seems like he's looking for another layer of a move. Screw the $200 million. He's literally looking for something that's the coolest part.
That's the crazy thing here. And the thing that it is actually quite consistent with the past 3.5 years of this entire saga, is that if a couple $100 million isn't going to do it for you, what is? And the answer to that question, which I think, a lot of people believe it's going to be a much larger number than that, and for him to have the confidence in that, to me, it speaks volumes. It really does. And so, I had said this, I think last week, if you don't think that GameStop is the most interesting thing in markets right now, like what are you even doing? How are you not just riveted by all of this?
I've been sucked in hook, line, and sinker. So
welcome.
So taking a look at his current position, GameStop closed at 25.46. I think you were saying after hours it's hanging around 26.
It's up almost 3.5% after hours, 26.34. But yeah, we can stick with this number for now. It's fine, close enough.
Yeah. Right? Yeah. Well, plus I'm not good at math, so for me to redo all this math, I think we're in the hurt locker there. But then also taking a look at his call options right now, they're trading for about 635 mid. Now, when we're talking about these positions and I'm using the mid price, it is so important to understand the context of the way I'm quoting this, because there is a 0% chance that he could sell this at this. That's not going to happen. Yeah. And the reason why that's the case is because as soon as meaningful amounts of this start to move, which we might have seen some of that today, we have to take a closer look in a little bit. But as soon as that starts to happen, you're going to see this market move. That's what it boils down to. So while I'm quoting it at this, I'm using the mid. It's really important to note that's not what he would actually walk out at. But it's also not the total inverse, where essentially if he started to liquidate this, all of it would go away and then there would be no market. That's not the case either. Some people think that there's no market available to him. He would get a market, but he would just pay with a pound of flesh to get a fill. Yep, exactly. So as we look at the unrealized P&L of the position, at least as of this point, it's looking right around 29 million bucks. And he still has 29.4 million in cash. So it leaves him in an interesting spot, because as we look at this position, he would need $240 million to take assignment of the entire position. So Dave, one of the things that you and I were talking about that I think is a perfect segue here is to discuss the idea of a cashless or a partially cashless exercise, because as we look at his position, it's been at different values where he really kind of could have done it a few times.
Could have. And that's the other, I think, surprising side to this. So last week, he was certainly in a position where he could have cashlessly exercised it, most, if not all of it, at some of those peaks, and he chose not to. That's an important detail, right?
Absolutely. And it kind of informs some of what we might be seeing. So for those that are unfamiliar with the concept, Dave, do you want to provide like a quick overview on cashless exercise?
Yeah, the idea with cashless exercise is that, here he has 120,000 contracts and he would need $240 million to exercise them. That's the 120,000 times $20 times 100 shares. But obviously he doesn't have $240 million sitting there in cash. And so what you can do is you can sell, if you go to cashlessly exercise, you can sell a portion of the position and use the proceeds of that sale to exercise the remainder.
Exactly. So as long as his P&L remains positive, it remains viable to him to a certain degree. The higher the P&L in the position, the more shares he could afford to onboard. That's essentially the simplest way to look at this. So we will pivot now, take a look at a bunch of the questions that you guys sent in, and then we will then dive into analyzing a little more in depth the kind of market activity that we saw today. So this was one of the primary questions that I saw, essentially, and forgive for this being blurry, it's a blow up of a blow up of a blow up. That's what this is. So everyone's gonna have to cut me some slack. Somebody screenshotted this, then threw it up here. I'm trying to make it somewhat legible. Here we are in life. But anyways,
you need computer enhance.
Yeah.
How doesn't that work anymore?
So this is one of the things that I've been infatuated with the ape community, and I continue to salute everybody there, because the way that you guys are able to find all of this information it's literally astounding. And this is relatively new from the OCC. And for those that don't know, the OCC, the Options Clearing Corporation, is essentially the clearinghouse for options transactions. And this is a relatively new change that somebody identified. And so that I'm not blocking the original poster, let me see if I just want to make sure I can give them credit. It looks like this post came from this person. Now, Dave, what do you make of this?
I just have to laugh. Like, this is so wild, right? So the OCC here has changed their terms of service, and they've inserted this one line, and I can't say I'm surprised in any way at this, right? This is obvious. I'm frankly surprised it wasn't already in there. We've not we as in you and I, but we as in our program and on our streams and for years since I've been in this sort of community of talking about GameStop and wondering, is there any type of systemic risk? And if so, what would happen under conditions in which that risk became acute? It's always been clear to me, and this is what happened in January 2021, which was that, authorities will step in and they will stop things from trading. They will close markets if they have to. Here, the OCC is saying that if it's in the public interest, or if there are simply unusual conditions, right, that they can postpone settlement of any option on any type of underlying interest. And of course, that's what they're going to do. And if any part of this becomes a systemic risk, the OCC will step in, the NSCC and DTCC will step in, the Fed will step in, Treasury will step, right? All of these parties will get involved if there's any type of systemic risk to the economy. And this is, like I said, this is not surprising, but that's, to me at least, exactly what this is saying.
And how do you think this actually occurs? What scenario do you think tips this off? And then what's the follow through if this is enacted?
So, I think that a lot of people believed that he was going to exercise his options position, and that was going to, that there was the potential for him to do that live on the live stream. And that if he did that, that would have led to such a short squeeze that the prices would have gotten egregious. And if you think back to January of 2021, Thomas Petterfy from Interactive Brokers was famously on CNBC came out and said, the entire system could have crumbled if options were all exercised, if everyone wanted to take delivery of the stock that was contracted and sold to them, everything would have come crumbling down. That's Thomas Petterfy, who is just someone. There's few people who know as much about markets as he does, and are as experienced as he is. And so for someone like him to say something like that, I think that's the type of outcome that people are hoping for and counting on, and that's exactly the type of outcome that the OCC is sort of heading off here.
Yeah. So it's one of those things. It seems like it's a temporary stop on that happening, but then what would the ultimate settlement be, in your opinion, if they ended up going through this? They postpone the settlement. Sooner or later, you have to settle. What do you think that process could look like?
I mean, it's hard. It's hard for me to speculate on something. It's totally, unprecedented. But you can imagine it involves the unwinding of certain firms who have gotten too deep into this and who have been left with massive balance sheet exposure and the inability to cover their liabilities. And then at some point, you can envision a scenario in which they don't have the assets to satisfy the liabilities. So either, the assets have to come from somewhere, or the liabilities get satisfied at a fraction of what they are, right? That's how bankruptcy tends to work. And so you try and recover what you can. So, I don't know. And I've always said that I can't, like the steps that would have to take place through this sort of scenario, I find hard to envision. But we saw craziness when Lehman went under, and a lot of firms failed when Lehman went under because they were, they were such a massive counterparty in markets. And then there was this craziness when Lehman went under from JP Morgan Chase, who was both the creditor and a custodian. And so they basically just said, well, now this is ours because it's owed to us and we have it, right? And it's hard to it took years and years and years of litigation after that. So, I think anyone who thinks that this is sort of the outcome that maybe we're headed for should probably be prepared for something like that.
And the main reason why I asked that question is to highlight exactly what you're outlining. This is one of those very anomalous events. None of us, there's no playbook here. We have some reference periods that we can look at to surmise what may or may not happen, but we have absolutely no true way to fully forecast what this will look like. So TBD, we'll see. But this is a really, really great find by you guys. Let's take a look at a couple of the other questions. This one's from Kevin. And Kevin says, what benefit was there what benefit was there at all to buying the 20 calls when the price was at the money with extremely high IV instead of 30 calls, which we made of twice as much money? And it's a great question. So there's a few ways to look at this. And the simplest answer here is high IV in this case was going to be kind of prevalent as those options started to move inherently. We started seeing stock price moving. And while high implied volatility means that the options are more expensive, it also means the options are expected to move more. So in this case, Roaring Kitty was essentially willing to pay up. That's what it boils down to. He was willing to pay the money to gain the leverage. Now, the other thing to keep in mind is the way that these different options behave. And the way something that's at the money, typically call it somewhere between a 40 and 60 delta. Typically it's 50 delta, but with something like GameStop, well, what is at the money even anymore? But it's typically around exactly. It's typically around a 50 delta. So what that means is he's actually striking a really fine balance between paying enough money up front to gain effective leverage. As your delta is higher, you get a higher dollar for dollar move with the underlying. That's what delta measures, the rate of change of an options premium. So if he has a 50 delta, GameStop goes up by $1, it means he will see 50 cents of that move, $50 per contract. Now, if you go further out of the money, they're slightly cheaper, but a lower delta. So what ends up happening is you get a lower gross dollar for dollar move, but your money can compound a lot more if you get a big enough move. So it's kind of a very calculated way that he applied the position. And we'll take a little bit of a closer look when we get into the platform and the option chains in a little bit to help clarify some of that. But in short, the way that I view this is he was looking to strike a balance. He wanted exposure to something that was going to compound, but not pay a ton of money by going super deep in the money. He striked it essentially right at the money, at least based on when we think he was transacting. And we can take a look at when that was as well on the platform. The next question here is, what's the impact of that many options as they get closer to expiration vis-a-vis hedging partially versus completely, in how that impacts the stock price? And I think, Dave, that's right up your alley.
Yeah, and obviously the caveat, I never did options market making. I did do ETF market making, and there may be some parallels when you think about sort of optimized baskets versus just completely hedging with the underlying. But I think there's nothing from an options market maker perspective that compels them to either, one, hedge with the underlying. There are other ways to hedge, and two, to completely delta hedge, or to remain completely delta neutral. While also, there are other, they have to also remain neutral across other metrics as well, from an options perspective. So, but if obviously, if you're strictly market making, you are going to want to generally remain delta neutral. You might have a lean, right? You might be cool being a little long or a little short delta, but it's not going to be anything crazy. That being said, there's the side of it where when you're further away from the expiration date, you might feel less of a need to be delta neutral than as you get closer to the expiration date. And that's where you probably want to hedge it far more. But again, these guys have pretty complex books that they're trading. They're trading across the chain, and they're calculating their exposure to each of the Greeks in real time at all times. And so, it's hard to speculate as to what the impact is directly on the underlying, but it's significant, right? For sure, you're going to be hedging a very material portion of that with the underlying. And I say that for sure if you are sort of a rational, by the book market maker looking to profit from the spread and not looking to take a directional position through the sale of options. And I've seen lots of speculation as to who was the market maker who sold these. Are they naked, these calls? I don't want to. I don't know. We have no way of really knowing that. So I'm not going to speculate on that. Certainly, that's a pretty substantial risk to take on. And generally speaking, these market makers really try hard not to take on that kind of risk.
Yeah, and you also have to imagine, it's important to remember, just like we were talking about, the unwind wouldn't be done all at once. It's the same thing when he was putting the position on. It was done in blocks over several days. So exactly to your point, it's hard to tell who's on the counterparty to all of those different blocks that went out.
Yeah,
so I think that's a really, really great way to look at that one. So moving over to this next one, which is actually kind of part of what we'll take a closer look at in a little bit, which is, would love to speculate if it's Kitty buying the August 16th calls and why the chain is becoming hot all of a sudden. Big swap expiration. So this one is actually a little bit of a preamble before we pop over to the platforms. But before we do that, there was one other question we wanted to hit before rolling over there. And Dave, I think you already covered a bit about the hedging aspect of the trade. And I think the way that this person is looking at the way that they're going to be hedging, they have to hold the position longer, anchoring. Like, I think in general, their logic is flowing intact. Now, you and I read this last part differently, which is actually really interesting because I read it with respect to the recent offering, which I actually think is the incorrect way to read it. And I think the way that you read it is correct, which is with respect to the actual options trade. So I figure since you're the one that we both think read it right, you probably are in a better position to answer this one.
Yeah, I mean, to me, the question is saying, does the exercise of an option create any kind of dilution effect? And I would say, look, by the book, no. By the book, you get shares delivered to you, and those are shares that are outstanding. You're not creating new shares. Now, that's by the book, right? And certainly there are times where, obviously, there are shares that appear in your account and then they're FTD. There's a failure to deliver those shares, and you could probably argue that FTDs are very easily argue, I think, that FTDs are dilution, in fact, and creates a larger supply of shares than what the issuer intends to have out there. So, from that perspective, possible. But again, I think, if it's, people hate when I say this, but if it's by the book, then no, there are shares being delivered, and those are the outstanding shares. And if he does something like, to DRS them, for example, those shares absolutely have to be delivered in actual form, not as sort of bookkeeping or book and some type of like synthetic form.
Right. Yeah. And I think it's a really important point, especially given the size of the position, right? Because when we look at the realm of possibilities for FTD, it seems, especially in something that's generally low float, it would start to increase the probability of that happening, at least to some degree. Now, dovetailing that into the recent equity offering, it's also kind of difficult to say how many of these shares have been scooped up recently by people who need to hedge their positions, and maybe they're even hedging more conservatively than they typically would, understanding all of the cards going on behind this, because that is one of the downsides of broadcasting the position as he did. There's a lot of people that know exactly what's going on now.
Yeah. So, and 75 million shares that were just completed, 45 million before that. You've just sort of, I think it's something like 30% dilution overall, and you've just, with the most recent offering, completely offset the shares that have been held in DRS form. And so that's not trivial. Like that's a material number of shares hitting the market, available for hedging. And so, yeah, it could certainly play a role.
Yeah. All right. So as promised, I'm going to move us over now to an actual trading platform so that we can take a peek at some of the trading activity we're seeing going on, because it has been fascinating today, to say the least.
The end of the day. Let's put it that way. Yeah.
So my screen should be getting pulled up right now. You guys should be able to see it. So first things first, we can see GameStop is still hovering right around 26 after hours. And if we pop open the expiration cycle that he's in, the 21 Junes. Now let's go back to the conversation about at the money, in the money versus out of the money, just to make sure that that's super clear to everybody. And also, again, we have to highlight all of the anomalies that is GameStop, because right now at the money here is a 60 delta. That's not normal. Normally it's around a 50 delta. It doesn't have to be directly 50, but it's typically around 50. And this has a lot to do with the way that we're pricing options, that sort of stuff. So we don't have to dive.
How many times do you find yourself saying that when you're talking about GameStop? That's not normal.
It's essentially we just got to leave that up somewhere, because it is a perpetual, there is no playbook here.
Right.
But the way that it typically will work is the higher the delta, the more expensive that option will be. So that means the more money you are paying for it upfront, but then you are getting a better dollar for dollar move with the underlying. So again, if you come in the money to the 70 deltas and you buy this 23 strike calls, you pay a little bit more money. But then if GameStop goes up by $1, you see 70 cents per contract on that. If you go further out of the money, let's say down here to the 30 deltas, way cheaper, essentially half the price. However, what happens in this scenario is you only get 30 cents per dollar of the move. So in this case, you get half the move. That's kind of the cool part about options, is their strategic investments. You can create the exact risk profile that you want. So in this case, the reason why, and again, nobody can say for sure, but as far as I can tell, The reason why he would go at the money is he's actually kind of finding a happy middle ground. His options can compound very nicely, and he's not paying as much as something that's super deep in the money, but he also does get a pretty significant compounding capability if he gets an accommodating move. So
and if your intention is to exercise, you're giving yourself a nice margin where he's at to be able to exercise, right? To be in the money enough that it's going to be worthwhile to exercise those options.
That's a great point, and something I want to hone in on really quick, because a lot of people, they're confused with options in that they think that it has to be in the money to exercise. And what you caveated there is very important, because technically speaking, with American style options, they can be exercised whenever you want. Now, whether or not it's logical or whether or not the OCC will allow it, that's a whole other ballgame. But it is a risk that exists in these options, and it's why there's a different pricing applied to American versus European style options, which cannot be exercised until expiration. But all that to say, that's probably why he went at the money. Now, the part that I'm actually really curious about is he didn't go that far out in time. And I would have expected him to go a little bit further out in time to decrease the theta decay, which is the daily slippage of time on the premium of an option. But the dude's probably just looking for a big move. Now, what did we see today? What's absolutely fascinating is if we take a look at this column, that's the
you just coined a great new term.
Column. Apparently, that is column and volume combined. For those curious, what that means.
That was great.
And if you take a look at this column, what do we notice? We see, a
lot of little numbers.
And to be clear, volume in options trading is just the number of lots that were transacted at that strike price. There's a difference between volume and OI, open interest. Open interest is those are contracts that have two sides and the contract is open. Volume can be opening or closing. It can be people buying or selling. And we don't know until we see the change in OI, whether they're new contracts being created or old contracts closing down. But some interesting things, as Dave was pointing out, nice low numbers, nothing big here. And then you bump into this one, super fascinating, one that happens to be at the 20 strike at the 21 June expiration. And this is 93,000 contracts transacted at that strike today. Very interesting. It is impossible to directly tell just yet exactly what's happening. But it would be reasonable to assume so far that this is probably a mix of buying and selling activity. And with something that size, with some of the position sizing we know exists with Roaring Kitty, this very well could be him liquidating some of his position. And we have no idea if that's actually the case. We have no idea why. It's too early to tell. We could be seeing a scenario where we're kind of going through this cashless exercise component. We could also see him potentially moving his options out in time because these expire in 9 days. So he does need to make a decision on what he's going to do with this position. And Dave, from a market making perspective, I'm sure you're probably better equipped to explain the ability for him to move his 120,000 contract position now that everybody and their mother knows it's out there and what it is.
Yeah.
It's not that easy. So what are your thoughts on the timing that he might choose to do something with this?
It's, again, it's like, I don't know, who knows? I assume that what we're seeing is him reducing his exposure at this strike in this contract. And what that means, though, who can say? Is he raising money to exercise? Is he rolling into the future? Is he just realizing some profit? I think he's going to exercise, but I'm saying that now, and who knows? It's going to be false, by tomorrow. But his MO in the past, at least, has been to exercise his options. It would surprise me if he put on this short-term options position entirely without the expectation of exercising at least some of them. And again, to me, as you said earlier, like, why didn't he go further out in the chain? To me, that's the answer to that question, is the intent was to exercise at least some of them, and maybe to roll the rest. So, I think we're going to find out pretty soon. We have to find out by the end of next week, that's for sure. But if we do see a significant drop in open interest tomorrow, then we know that this was not just a bunch of trading going on. This was closing of some positions. But, until we get his position update, not sure.
Hard to tell.
What do you think? You watch this stuff all the time, right? And another question that I saw come across was, have you ever seen anything like this? Is there anything that you can draw parallels to in your experience trading options?
Nothing that's quite the same. Like, that's the tricky part. You can come across different formats for squeeze scenarios, and squeezes happen. Gamma-driven squeezes are slightly different, which is when it's driven mostly by market makers. Those are a little more unique in nature, but not anything to the degree that we're seeing here. And that's actually what makes it so fascinating to me. I haven't been in markets as long as you have, but I've been trading for 16 years now. And it's not that common. You come across stuff quite like this. So when I look at this position, I have to assume some of this is unwinding. And it's hard for me to tell just how much. But this, I think when I look at this pop in volume compared to everything else that I've seen, and I have a bunch of different scanners set up to detect anomalous volume, which is funny because before we started, you asked if I saw it, and I hadn't seen the actual expiration yet. I just saw an alert pop up for other expirations. So if we take a look down at the bottom here, you can see today that there were almost 761,000 calls transacted and only 444,000 puts. And if we take a quick look at a couple expirations, the 21 Junes, again, this is using previous numbers, so we have to wait and see what this updates to. And this is just looking at volume. So if we take a look actually at OI and we look at the 21 Junes, it was at 472 earlier. And then if we pop back to volume, that 214 today. So a lot moving, half of what exists in the chain. But part of this is not super anomalous for stuff that's coming up on expiration. You have to do something with your options.
You got to do something, right?
So it does beg the question, as we look across other expiration cycles, though, and we look at volume, if we go out just to 28 June, there's not much. And to be clear, just to kind of cliff notes this, if you look at all these different weekly expirations, if we click in here, you'll notice that they will be slightly less liquid. They typically will have way less volume in OI. And it's just because people, especially with bigger positions, are hunting for liquidity. You have to trade where there's an efficient market, at least as efficient as possible. So if we fast forward out to the 19th July, you'll notice that this market is definitely more liquid. But if we take a look at the volume, there's nothing that matches anything close to what we saw on the previous. And then if we come out here to the 16th August and we start poking through, there's still not that much today. So we see 1,500 lots, 1,700 lots, 1,000 lots transacted today. There's just not that much. So
we did get a bunch of questions on, is he rolling into the August 16s? From this perspective, doesn't look like it. Not, at least not in the kind of size that he was in the Junes.
Which then opens the scenario for a hybrid between cashless exercise, rolling options out, which I think that is not improbable. However, it also looks like he kind of keeps it simple, right? Like if you look at his book, it's two things.
Keeps it
so I'm actually not sure that would be the route he would go either. That's kind of the fun part. It's all a guessing game at this point. But right now, what we can say definitively, there's a lot of activity going on in the 21 June expiration. There's a lot of activity going on at this 20 strike. There's not a corresponding amount of activity out yet at the 19 July or the 16 August main expirations. That's essentially what we're looking at right now. So
fascinating. All right. Thanks, Eric. I think
TBD.
this has been great. I hope everyone found this informative. And certainly, as we know more, we're going to jump back on and stay on top of this and keep exploring what's going on and update you with the latest information as we all learn it together.
The saga continues.
Yeah. All right. Awesome. Well, thanks again.
Thanks, everyone.